Hello, hello, hello. Welcome to the new Sunday live stream. We're going to try to do this every week. Laid back, relax, no pressure. Just a hangout stream to go over the news this week, what's going on, some memes, some gags, some fun, just to hang out for about an hour or so. I'm not posting this anywhere. So if you're here, you're an OG. And we're not going to be talking about the earnings of Palantir today. We have a whole freaking live stream set up tomorrow with me, Amit, Chris Patel. A lot of like good guys are gonna come on, and we're gonna do the live stream. Um, so today is just kind of a laid back stream, just for you guys to hang out, and I've gathered some funny headlines for us to go over, which I think we can really have fun with. Um, Hello, Amit. I was just telling them about our stream tomorrow. Tomorrow at 8 a.m. We're gonna go live, talk about the Palantir stuff. Yes, I think it will be $8 tomorrow. Oh goodness. So I'm not gonna do this crazy, like there's no replay value for the stream, but I do want to show you some headlines which I saw, and some of them are quite hilarious, some of them quite interesting. So first of all, I want to pull up. Let's do this here. Let me just. Where is this? Just give me a second. I'm trying to gather some stuff. Why can't I find it? Oh, I know why. Okay. Hang on a second. Hang on. Give me one moment. I'll be back. Okay. I got it. So I sent an email to myself with all the headlines that I gathered, and I couldn't find it, and I got it now. I forgot to press send. So let's pull it up on the screen. Okay, so this is the first one. Oh, okay. So I'll start with the more serious stuff, and then we can talk about some memes. Um, so there's this email that came out. By the way, Amit, let me get rid of your comment. Yes, I will. Thank you, Nick, for letting know. So there's this headline which is going to make a lot of news tomorrow. Uh, Basically, from Bloomberg is saying that now Elon Musk and his transaction are at risk of getting basically reviewed by the FTC. So essentially, what they're saying here is that, you know how we were assuming that the deal is basically. Let me just pause this thing so it doesn't play right in front of you.
It's a smart.
So basically, they're saying that the Twitter deal is not as smooth from a regulatory perspective as we initially thought, which is a bunch of bullshit. Now, I spoke about it today during our. We had a Zoom call today with my community, and we talked about this today. I just want to let you guys know that this is just a bunch of bullshit. So basically, and why is this important? Well, because I think a lot of you, actually I'm doing a risk arbitrage on this deal, so I'm actually invested in this risk arbitrage deal, which means I've bought Twitter stock at the current price in the belief that the deal will close as planned, and I will get $54.20 per share. At this point, I think the gap is on 10%. And the idea is that I think it's a very simple deal. It's one of the simplest one that I've seen. 6 months, that's the maximum amount this can take. And essentially, so if you buy today at 49, the payment comes in at 54 and 20. When it happens, you get 10%, assuming that the deal actually actually goes through. Now, this headline I think will cause a lot of people to think that the deal is not as simple as it is because there's antitrust issues. This is just bullshit. Now, if I'm not going to do this right here, but you can read this article. Essentially, what they're talking about here, this is a pushback from two perspectives. One is that Elon forgot to notify them initially about the acquisition, so he forgot to notify the FTC. Oh my goodness! I mean, it's a technical foul. There's nothing gonna come of it. The other thing is they're saying here, which is this one, Open Markets, which is a non-profit group with ties to Lina Khan, which is the current chair of the FTC, is arguing. Check this out. I'm not even making this shit up. That this deal would give Elon Musk too much control over free speech. The open market nonprofit is claiming that this deal would give Elon Musk too much control over free speech. Uh, this is not a term that can be used to analyze antitrust deals. I mean, antitrust analysis for deals. I mean, the law basically has no too much control over free speech clause when it comes to antitrust. And obviously, if you look at this, this is corporate talk for basically saying this is nonsense. They're saying here antitrust experts don't expect the deal to raise antitrust concerns. So this is Bloomberg's way to say that this is bullshit. I explained this in my Zoom call today. The antitrust authorities can only classify a merger as vertical or horizontal, and in any case, they'll examine what will be the impact on competition within that category. And if there's less competition, they might look into it. So let's say that if two companies who compete against each other are being merged, that would be an issue of concern. Here you have an individual buying a company, so there's no vertical or horizontal merger at all. So this deal doesn't even go through the threshold of an initial FTC analysis. What they can do here is they can put a monkey wrench into the deal, and when the FTC decides to initially review a deal, it's like a 30-day period. But this deal is not going to close in 30 days anyway, so it's pointless. So when you see this headline tomorrow, what I would do if I like what I will do probably is I'm going to see if this headline actually gets people more terrified that there's now a better like a worse probability that the deal will work, and if the price falls even more because of this headline, I'm going to be buying more because I think the risk arbitrage on this deal, which is now 10%, and I believe with this headline will be more than 10%, is just ridiculous given the fact that it's a straightforward 6 months deal with absolutely seems to be like the most simple, straightforward purchase. I've never seen a $40 billion deal that's that simple. Shout out to AEG001 for the $10 donation. Thank you so much. Love your channel. Love you. Thank you for the donation. I really appreciate it. Thank you so much. Kindly. So that's number one. So that's kind of just my initial. I told you I'm going to be focusing on risk arbitrage deals for the next few months because the market is doo doo. The market is going to the toilet. So this is one of my deals. I will also be looking at Activision, Microsoft. On this deal, I think the odds are stacked basically very heavy that this deal will go through. And so I think this headline will scare people, which will increase the arbitrage. And before I move on to the next headline, I want to read a few comments. I would not buy oil unless it's a short-term swing trade. Yeah, I don't know the trade in energy. I think energy trading is just too crazy. I don't understand nothing about it. And I Nash, make this bleed stop, my friend. I cannot stop this bleed, unfortunately. What I can do is I can show you actually, if you guys want. We also did this today in our Zoom call for patrons and channel members. I showed them this little thing right here. Let me try and if I see if I can pull it up. So where is this? Yeah, this is the one. So I showed them this table, which I'm going to show you here on stream, which should really be, I guess, of interest to you guys. So look at this thing. So this is what you're seeing on the screen right now. Oh, I cannot share. Oh, yes, I can. Okay. So what you're seeing on the screen right now is basically a table that shows you, yeah, what happened every time the market crashed in history. So right here, there's, I believe, 20 times the market crashed. And the definition of a crash for the purpose of this table, I believe, was done by Bank of America. Yeah, Bank of America did this table. So in the 20 times the market crashed in the, I believe this goes back to 1892. So what, 140 years? So in the past 140 years, we had 20 crashes, and the crash is defined for the purposes of this table as 20% drop in the S&P 500 or more. So in the 20 times the S&P 500 dropped 20% or more, this is how it played out. And you can see the different percentages here and the different time frame. And I want to explain what you're seeing on the screen. When it shows you peak, this is like when everything was peachy. In our example, this is December 27th. You remember the Santa rally? So the Santa rally happened on December 27th. It was at its peak. So for our purposes, the peak of this bear market right now is December 27th. Then the next table says through. Through means when it actually found bottom, not went up, found bottom. So it says found through means found bottom, when the bottom actually happened, when it stopped bleeding. So as you can see here, the different dates, you can look at the recent one, which is 2007. This was the subprime mortgage. For those of you who remember the subprime mortgage in 2007, it bled for almost 2 years. You see, it started in 2007, ended in 2009. So the bleeding went on for 2 years. And as you can see, the next table is the decline. And decline means how much the S&P 500 fell. So in 2007, when we had the subprime mortgage crisis, the decline was, let's see together, 2007, 56%, 57%. So if we want to kind of talk about what happened the last time we crashed hard, like the real crash, the most recent crash last time, I believe this was 2007. Uh, we had little minor kind of dips, but 2007 was the last big crash. So last time we crashed, it went on for 2 years. The falling down went out for 2 years, and it dropped 60% or 57%. The S&P 500. So if you compare it to where we at right now, just to explain to you why I said that I think we're not there yet. Right now, we are down 14% on the S&P 500 from December 27th to now. So we are 5 months into this, and we're down 14%. Last time a crash happened, we were down for 2 years, and it fell 57%. So as you can see from this table, at least if you use 2007, the subprime crisis, as the reference, we're not close to the end of this, it seems. Now, there was a guy who actually averaged out all of this. I forget his name, but he has an article, and he made an average out of all of this. And the average that he found was that the average drop in the S&P 500 in those 20 crashes before it stopped was 37%, and the average time until it found bottom was 10 months. So again, if you want to use that as reference, we're at 14% and 5 months. So half and much more. So using statistics from what happened in the past, it seems like there's more bottom to be found here. Again, it's just statistics, and it doesn't mean that things will repeat themselves. And by the way, a huge shout out for Ashutosh Ja for the $5 donation. Thank you so much. I appreciate it. Thank you so much. So basically, if you want to use statistics, so you saw the numbers, right? Average is 10 months, 37%. The 2007, which was the most recent one, was 2 years and 57%. We're now at 14% and only 5 months. So things are not as bad as they could be. Let's put it this way. Now, I've also kind of talked about this today, but even if you want to add into this a little bit of a fundamental analysis, and you want to talk about, okay, so it's just stats, right? Statistics and past performance does not guarantee anything. And I agree to that 100%. So let's say now you want to add to this some qualitative analysis, basically looking at the fundamentals and seeing, okay, so what's going on right now in the market? How likely is the bear market to happen? Because may I remind you, as far as the S&P 500 is concerned, we're not in the bear market yet. The definition of a bear market for the S&P 500 would be 20% drop of the high, and we're currently at 14%. So we're not there yet. So we're just to kind of emphasize to you how things can really get much, much worse. So assuming, okay, so now we know the statistics. So if you look at the fundamentals, and I spoke about it today earlier during the Zoom, if you look at the fundamentals, I mean, can you guys think in the chat? I mean, chat, can you think about any positive catalyst? If you can think of a positive catalyst for the stock market in the next year, please put it in the chat. I mean it. I don't mean to be cynical. If you guys, anybody who can think of a positive catalyst in the market for the next 12 months, put it in the chat. Because I know that there's really horrible catalyst in front of me right now, which is massive inflation, interest rates increases, supply chain shortages, lockdown in China, deglobalization, and supply interruptions, wage inflation, geopolitical instability. So these are the things I'm seeing. Not to mention food shortages, not to mention fertilizer prices going through the roof, not to mention wheat shortages and massive more destabilization coming as people run out of food with everything's going on in Ukraine and Russia. So many, many negative catalysts are coming. So what's the only positive catalyst? As yes, that is true, by the way. Cameron, you are 100% correct. Nasdaq is in bear market. It just passed 23%. Yes, Nasdaq is in bear market. S&P 500 is not yet. So the only positive catalyst, as Jorge is saying, Jorge Cervantes is saying in the chat right now, is the end of the Ukrainian war. If the Ukrainian war ends, that would be a really good positive catalyst, because assuming that it ends with an agreement that would be acceptable on the West to the level where sanctions will be lifted and trade will be resumed with Russia, Ukraine, Belarus, China, India, Brazil, all this block of countries who are separating from the West, will basically everything will be kind of rolled back. If this ends in a deal that is acceptable on the West, then yes, this is a positive catalyst and we will see an impact on the market. But you have to ask yourself a question. How likely do you think the end of the Ukrainian war by an agreement that would be acceptable on the West is? In my humble opinion, I think it's more unlikely than likely. And I'm going to leave it at that. People are saying, yes, end of the war. Transitory inflation, Franco, I don't think that's happening. Transitory inflation is much like Back to the Future 4, never happening. Yeah, it's not really a positive catalyst when everybody's bearish, but I agree with you, everybody is bearish. War ending. So everybody's saying war ending. I agree to that. Yes, I agree to that. War with Ukraine ending is the biggest catalyst we can see. And once that happens, the market will bounce. But I would just make sure that we don't get ahead of ourselves here, because to be honest, as things are developing right now in Russia, from what I understand, because I tend to follow that part of the world, obviously, as you know, things are looking like it's going to escalate into an attrition war and not into a peace treaty. But who knows? Maybe just out of the blue they sign a peace treaty tomorrow, and if they do, the market is going to bounce. So let's hope. But at this point, it's mainly hope, and less, I would say, probabilities. But let's see what happens. COVID gone, yes, this would unlock China, which will ease supply chains a little bit, but it would not be dramatic as much as Russia and Ukraine at this point. Hyperinflation is not a positive catalyst. Cat McGee, as a cat, I'm assuming you didn't know this. It's a bad thing. Yes, people saying end of war, 100%. I think that's too late, Carlo, saying inflation not as bad as they thought. I think inflation is actually much worse than they thought. So yeah, I agree with the people who are saying uh, that end of the war would be a positive catalyst. But I think that if we are honest with ourselves, I think it's less than 50% that this happens. But even then, even if the war ends, and then we still have supply chain issues, money supply. Like there's still a lot of problems in the let's call it in the system. Um, yeah, I agree with Erwin. Erwin, one of our moderators in the chat, is saying turbulence ahead. Put on your seatbelts. I agree with that 100%. I agree. Um, somebody saying 10% chance of a peace treaty. I would say that it's probably in that vicinity. But hey, yesterday, Canelo went into the ring with a guy nobody heard about, and he lost. So if Canelo could lose to Dmitry Bivol, maybe we can get a peace treaty. I know who knows at this point. Um, I want to just. I saw there's another super chat. I want to get to it. Brian P, thank you for the $5 donation. Brian is asking, are we headed for worldwide economic collapse with all the debt and money printing endless money? Not necessarily. I wouldn't say we're heading to a worldwide economic collapse, but there's a big debt problem, at least in the US, which I've spoken about quite a few times. There's an issue with the way we have been increasing our debt, and that actually started for decades ago. It's not Biden's fault. It's not even Trump's fault, believe it or not. This is something that's been going on since the 90s, and unfortunately, this could have been evaded quite easily, but as the US basically since the 90s actively shipped out jobs outside the US because it made sense economically, it would cheaper to manufacture in China, in India, or whatever. So as the US systematically shipped out jobs, manufacturing, basically everything outside the US has slowly became a services-based economy. So the US is a services-based economy. Nothing is really manufactured anymore in the US. If you think about it, it's mainly in China or India or whatever. And when you're just an importer in a services-based economy, then your deficit goes through the roof. And as long as everything is fine, it's not a problem. In fact, it's a really nice way to grow. But the minute something really bad happens, like elevated interest rates, like we're having right now, then you're literally in a position where you cannot service the debt, which is at where we at right now. And I can talk about solutions to that if you want. I have some ideas. So if there's any demand in the chat, you know what I'll do you a solid. So Brian, thank you for the donation. If you want me to go into a really deep, geeky breakdown on how to solve the US debt problem, I can do it. And so if you want this geek analysis of how to solve the US debt problem, put one in the chat. And if you don't want this atrocity, which I would assume would be the better option, put two in the chat. So one for the analysis, it's going to be very nerdy and boring on how to fix the debt problem. Number two is basically moving on to some more funny stuff I have, because I have a lot of funny stuff prepared, some articles I picked up. So jokey jokey, mimi mimi, or yeah, somebody put 69 in the chat. Come on, bro. Uh, of course, there's always going to be a guy who's going to put 69. Okay. So it seems like there's an overwhelming. Somebody put 420. Uh, somebody asked if I'm still buying Palantir stock. Yes, I am. I'm always buying Palantir stock. So it seems like there's a lot of people who clicked one. Hey, so I'll do kind of a hybrid, okay? I'll do a 5 minute about the debt, and then we can move on to the funny stuff I have for you because I have like crazy headlines. You'll see it in a second. So, um, you know what? I'll use. I have an idea. I have an idea. Hold on a second. I got an idea. I got an idea. Hold on. Um, where is this? Okay. Did anybody see the Trevor Noah rant about? We can do it later. Okay, I'll talk about it later. Anyways, so let's do the stuff I told you about. Okay, so here's the thing. Um Vitali, I don't think it's a good time to buy equities right now. Just to be kind of honest, right now, it's not a good time to buy equities, in my opinion. Humble opinion, not financial advice. Hey, Adam, thank you so much for the. You, it's not necessary, but thank you for the very generous $20. Privetic Tom, just showing love and support. Great channel and content. I'm for Mother's Day, so can't stay. Thank you for the content. Cheers, Brighton Beach here. Hey, Adam, I think I caught you on the midstream, so good to see you and thank you for the donation. I really appreciate it. Thank you, my guy. Really, really generous of you. So let me be quick about it. So the way things have happened over the past 30 years is basically uh, the way the US prints money. When you hear printing money, more often what they're talking about is the US issuing bonds. And issuing bonds basically saying, hey, uh, basically you can I'll owe you money, right? Dear bondholder, the US government is owes you money, and you give us the money now, we'll pay it back with interest within 3 months, 10 years, 20 years, 30 years, whatever the bond is, right? And when you issue these bonds, that's how the US government gets money. And for for obviously for reasons I'm not going to get into in this video, but because the US holds the world's most important currency, which is the US dollar, and thank you for their super chat, Dynamite Poop. Dynamite Poop? Is it Dynamite Poop? We just got us demonetized. Thank you for that. Um, okay, so let me explain. So basically, the way the US works is because look, we because the US holds the world's reserve currency, which is the US dollar, for many reasons. The issuance of these bonds is very cheap for the US. The interest is very low because it's considered a very low risk bond. I mean, think about it. If you're buying a bond from the US government, what is the likelihood of this bond not being paid back? It's very low. And thank you, Chris, for the $2 donation. I appreciate it. Thank you so much. So the chances of you not getting your money back is slim to none. So because the risk on this bond is so low, the US government is able to issue these bonds at a very low price. And the reason the risk is so low is because everybody needs dollars. Everybody needs dollars because every single oil deal that's being done with OPEC, for example, is done with dollars. This concept is called the petrodollars. And basically, since every government buys oil from OPEC, it needs to hedge against the cost of oil, and it hedges with the same currency. So there's this cycle of demand for the dollar, which is based on petrodollars mostly, but mainly except for Russia right now, mostly commodities deals are done in dollars. Most of the world's global trade is happening in dollars, beyond just the petrodollars. And because of that, the US government can basically say, okay, so we need more money, some bonds, and you do it cheap. And the problem is that this bond, and again, this is not Biden's fault or Trump's fault. This has been going on for decades. The problem is what happens when you take on more debt and more debt and more debt and more debt, right? Yes, Simeon, this was your idea, by the way. So I'm implementing your idea. So basically, when you stack up this debt on top of each other, you know what happens? Like the guy who basically maxes out credit cards and gets new credit cards. Eventually, the party's over. So we have been going through this really bad cycle of collapsing under the weight of our own debt. Right now, the US has, I believe, 2 times more debt than its GDP. Not 2 times, sorry, time and a half. So our GDP is $21 trillion, and our debt is $30 trillion. So we have 1.5 times more debt than GDP. That's insane. And there are countries who have it worse. Japan, for example, That's a whole different discussion. But we have a lot of debt, and the service of this debt, basically the interest payments on this debt, are very expensive. When you owe $30 trillion, you pay a lot of interest. And imagine that we're now paying about 1.5% of our annual GDP as interest payments right now, with 0% interest, or 0.25%. So at 0.25% interest, we're paying 1.5% of our GDP just for interest. Just to understand how much is 1.5% of your GDP, the US spends about 2.5% of its GDP on education uh, and R&D, I believe. I don't remember, but it's insane. It's probably one of the biggest expenses, individual expenses in the budget. And that's with no interest. That's with no interest. And you can keep it going to an extent. I mean, mathematicians who work for the government calculated, and that was before the interest rate hikes. That was before everything went to shit. There, people were basically saying, "Hey, by 2050, if we keep this up, we're going to end up paying $60 trillion in interest payments, and our interest payments will be 9%. 9% of our GDP is going to be interest by 2050 if we don't stop this madness." And this was with 0% interest. This was like before the pandemic nonsense, before everything went to shit. And people were saying, "Well, this is like insane." It's essentially, the anticipation was that by 2043, the interest payments would have become the single largest expense, more than any governmental program would be interest payments. And by 2050, it would be almost 10% of our GDP. And obviously, when 10% of your GDP is just repaying loans, that means money gets taken away from security, education, roads, infrastructure, healthcare, you name it, right? And so now it was already kind of shaky, and we were basically wobbling with this debt. Now imagine we're looking at more interest. Just to explain to you how much more interest means, so for the US to be able to raise 1% of interest, so right now we're climbing from 0.25 to 0.75, and then next time we're going to get above 1%. So 1% of interest would cost the US government approximately $300 billion in annual interest payments. $300 billion in annual interest payments for each 1% of interest. Okay? Now think about it this way. If that's the case, I mean, try to estimate how much we need interest rates to be to battle a 9% inflation. Assuming inflation stops going up, assuming we have completely we freeze inflation at 9% artificially, how much interest would we need to stop a 9% inflation? So I'm not going to bore you with this, although I'm sure most of you are already quite kind of bored from this. So for 9% inflation, there's a very famous individual who actually is still alive, believe it or not. And he actually is so successful, they named a rule after him, which is called the Taylor rule. Taylor made up a very famous rule saying, well, he didn't make it up. I mean, he built it, saying that what you do is you take whatever inflation you have right now, which is 9%, you subtract good inflation, which is 2%, and then you multiply the result by 2. So if the result is 9 minus 2 equals 7 times 2, we need 14% interest. So as it stands right now, the US needs 14% interest to battle 9% inflation. And that's just consensus if you're not a politician who cannot say the truth. If you're like a normal human being who can speak freely in the living room. So basically, yes, AFB was right. He said it before I said it, so he knew it in advance. Yes, 14%. So now, basically, so you need a 14% interest, and each percent would be costing the US government an extra $300 billion per year. So now do $300 billion times 14. Okay. Okay. So let's do math. I mean, I don't have a calculator here, but let's pull up a calculator, right? Let's do a calculator. So we'll do it together. So 300 billion. How much is 300 billion? Is a lot. Times 14. How much do we get? We get $4.2 trillion. $4.2 trillion the US government needs to pay interest on 14%. Okay. That's an extra $4.2 trillion the US government does not have. Just to explain to you how much is $4.2 trillion, this is literally the annual tax collection of the United States. So the US collects about, I think, $3 to $4 trillion per year in taxes. So this number I just told you, which we need extra, is basically 100% of our current tax collection. And that's a big problem. And obviously, any kind of normal person would tell you that okay, so now let's say you raise interest to 14% and you need to come up with an extra $4.2 trillion. Now in that case, you'd have to literally print money, not borrow money, literally print money in the printer and essentially flood the market with $4.2 trillion a year. You know what's going to happen to inflation? So you just implemented 14% interest, which is going to crash the economy and the stock market, and inflation doesn't budge because you just flooded the market with a shit ton of money. So until you figure out this problem with the national debt of the US, you cannot raise interest rates. And since you cannot raise interest rates, inflation is going to go crazy. So you would have Jerome Powell on TV basically lying to you, me, and everybody that everything is fine. So it started with everything is fine, it's all transitory, don't worry. It then switched to, well, just 0.25%, and now it's okay, 0.5%, but they're pretty much very close to how much they can raise until it's just literally the US can't pay the debt without printing like an obscene amount of money. So it needs to be solved. Okay. It needs to be solved because the US absolutely needs to raise interest rates to battle inflation. You can go back to the 80s. So this is the highest inflation we had since 1982, I think. So, and go back in history and check how did we get rid of inflation in 1982. We get rid of inflation in 1982, which is a long time ago, 40 years ago, because we had a crazy psychopath of a Fed chair. His name was Paul Volcker. And Paul Volcker basically, in conjunction with Reagan, implemented insane interest. Like, I don't even remember the numbers. If anybody can put in the chat what was the interest rates in the 80s of Paul Volcker, I assure you this was something insane. It was I think in the 20s, something crazy, something crazy. And I'm gonna, if this doesn't come out in the chat, I'm gonna look at myself. But it's, yeah, what people are saying 20%. Yeah, it sounds about right. 20%. I don't remember. Whatever, it was an obscene amount. So the problem is that once Paul Volcker did this with Reagan, we didn't have this massive debt. Yes, James, I agree with you. It was in the 20s. I don't remember exactly how much. We didn't have this insane debt that we have right now. And now it's a whole different enchilada. Now we're really pretty much screwed. Let's put it this way. So how do you solve this? So the only way you can solve this, the only way you allow a runway for the Fed to raise interest rates is by solving the US debt problem. So how can you solve it? Well, you absolutely have to increase collections of tax. In fact, at the very minimum, let's say you want to raise interest to 3%. 3%. 3% interest, which is still far away from where we are right now. And if you're wondering, why is taking the Fed so long to raise interest rates? Now you understand why. So if you want to get to 3% interest, you need $1 trillion of extra tax revenue for the government to be able to afford the debt. Okay. So now make a calculation. Where do we get $1 trillion? Now there will be people who will tell you this, uh, and this would be a mistake to listen to them. They will tell you, "Hey, we should increase tax mainly on corporations, and when we increase the tax on corporations, we're going to increase the collections of tax by 1 trillion easy." And these evil corporations, we just they're stealing our money. Let's just tax the living crap out of these corporations. Let's just get it. Now, what they don't understand, these people, or they even worse, some of them understand this and they're still saying this even though they know it's wrong, because they're lying to you because it sounds good and it's an easy sell from a PR standpoint. So they either don't understand this or they're intentionally lying to you, and I don't know which one is worse. Is that once you raise interest rates on corporations beyond a certain point, the collections of tax go down. So the way collections of tax work, and I can show you this, it's very, very simple. I'm just gonna show you on the screen. I'm gonna pull up on the screen. 1 second. I'm not very good with the technical stuff, so bear with me. Okay. Okay, can you see this thing on the screen now? The multiple examples of this curve. This is called the Laffer curve, and you're seeing multiple examples of how it looks like. And I'm not going to take a position here to tell you which one of these is the correct one, because there's many correct ones. But the idea is that it's at a certain the vertical line is the percentage of tax. The horizontal line is how much tax you collect. And the idea is, as you raise the taxes, the collection goes up, right? You can see it in the Laffer curve. It always goes up, but then it starts to curve. So at some point, when you're raising taxes, you're not getting as much linearism in the tax collection as the increase of tax. And at some point, even further than that, which is called the equilibrium point, your increasing taxes actually decreases the amount of tax collected, because at the certain tax burden, the companies would just have so much incentive to plan around your tax and use loopholes and absolutely invest obscene amounts of money in evading this tax, that your collections will go down. So the question is, right, and this is the $1 million question, is where is this equilibrium point? And I'll show you. I don't need to guess this, because people have already done this for me. So this is I'm going to show you right now on the screen. So the optimal point is right here. If I can find it. Oh man, I suck at this technical stuff so much. Bear with me. I need to get like a course how to do this better. Okay. So on the screen right now, what you're seeing is the magic number. This is the magic number. This is the average in the OECD. Okay. I believe the OECD is the world's richest 40 countries, if I'm not mistaken, but that's kind of like the extension of the G8. These are like the world's top 4 countries. And in the OECD, the average corporate tax rate is 23%. 23%, right? So 23% is the global corporate tax rate. For years and years and years in the US, we had, I believe, was 35% corporate tax rate. And with added state tax, the average would, it could go to 39% tax burden on companies. So Donald Trump came in, and I'm not endorsing Donald Trump here. Don't get me wrong. All I'm saying is that it was actually a smart move. And he basically said, well, look, guys, we have all these companies running away from the US because we tax them 40 cents on the dollar. Rest of the developed world is taxing them 23 cents on the dollar. So let's go a little bit below the average. Let's go to 21%. So then the US goes to 21%. Now, if you factor in state corporate tax, because what we're talking about here is federal corporate tax, which is 21%, and beyond, except Delaware, Florida, Texas, and a few other states, you also pay corporate tax in the state you're located in as a company. So with state taxes, you're probably at 23% in the US. So basically, what Donald Trump did in his tax reform, he essentially equated the US corporate tax liability to the average in the developed countries. Okay. And now here comes the interesting part. So basically, what I can tell you with a high degree of certainty, and I don't need to be a genius for this, is that if we increase the corporate tax in the US beyond 21, 22, 23%, like people are suggesting, we're going to lose revenue from tax. Make no mistakes about it. The 21%, 22%, 23% is that equilibrium point on the Laffer curve. And that's not me saying this, that's the OECD saying it. And the OECD and basically have data showing that. So if we cannot increase tax, what can we do? And I tell you, I have a solution. So we cannot increase tax rates. It's not a good idea. Even as much as I want to tax corporations more, I know pragmatically that if we increase the rates on the corporate tax, we're not going to tax them more. They're going to plan themselves out of it. Trust me, I've seen it happen in real time. So how do we do this? Well, there's two ways we can generate an extra $1 trillion for tax. Hold on a second. Okay. So the way we can do it is with implementing two things that are basically major loopholes in the US for tax evasion. The first tax evasion, which is almost grounded in the way the US tax system works, is that multinational companies around the world that are based in the US, that are managed from the US, that are controlled by US residents, US citizens, do not pay tax in full in the US. They pay a small percentage of tax in the US, but mainly they pay tax in other countries with better, cheaper corporate tax, like Ireland, for example. Go check me on this. Go check where the headquarters of Google and Facebook, et cetera, are. They're in freaking Ireland. Because in Ireland, they pay less corporate tax. Simple as that. So you have these fake structures where all of these US companies cosplaying, pretending to be Irish companies and whatnot, and not paying tax in the US. And as this keeps on going on, these governments collect tax, and basically the US is left with the breadcrumbs of whatever these companies decide to bring back to the US as dividends, which is obviously, you can realize it's nothing. So the first thing that needs to be done, and this is actually done they're very smart about it. The way they do it is they basically define, well, in Ireland we sold all of our intellectual property to the Irish entity. Our management is in Ireland. The Irish company is signing all the contracts on our behalf. The only thing we have in the US is just marketing. So we should allocate a little percentage just to, for the marketing department. Everything else is in Ireland. While in fact, the center of their business is in the US. I think none of you would argue with me when we say that all tech companies are the center of any tech company is in the US. It's the biggest market. It's the target market for them. It's where all the networking is. It's where all the funding is. It's where the center of the universe for tech is the US, for anything really. So how come we're providing them with all the infrastructure, right? The roads, the education, everything, and they don't pay tax? So the way they do it is basically they hire professionals to write these transfer pricing studies that show why the US should not be taxing the vast majority of the income of these companies. So this needs to stop. Simple. By the way, if you stop this right now and you legislate anti-evasive provisions to stop this from happening, basically saying, hey, if the IRS says that no matter what the papers are saying, if the IRS says that this is a US centric company, you're paying tax in the US. And whatever's left after the US finishes collecting tax, it's 21%, they can pay elsewhere. No problem. If the other country has 30% tax rate, you can clear the extra 10% after us, but we feed first from our companies. So if the United States does that, that is an easy $1 trillion right there a year. The estimations are that about $1 trillion is an offshore tax loss every single year. So the US just by doing that adds another $1 trillion to its tax collection every single year. Now, you can also close, that's one part of it. That's a trillion, that's 3% of increase right there. You can also get another percent by finally closing the loophole of the rich assholes who don't pay tax on the estate tax. In the US, there's a law that says that when a person passes away, the children or the wife or whoever inherits these assets should pay, I think, 35% gift in estate tax. I believe it's 35% or 40%, don't remember. There's a tax levy on inheritance. So basically, once you get the house or whatever, but there's an exemption that says anything up to $5 million is exempt. And you know what? That's fair. If a person accumulated $5 million in his entire lifetime, it's his right to leave it to his kids without the government touching the fuck out of it. And I'm not saying to get rid of the exemption. No. If somebody accumulated $5 million in this entire lifetime, it's his right to give it to his kids. No problem. But I'm talking about the big money. The big money isn't the 5 million. The big problem is what happens if you have above 5 million. So go check me on this, the statistics. You know how much people paid out of the entire inherited amounts last year in the US, which was above $1 trillion. $1.2 trillion was inherited in the US last year. Less than 1% of those were taxable. 99% of this was not taxable. And the reason is because what these people do, the ones that have more than $5 million to inherit, is they put these assets in a trust, and then the trust owns the assets. So when this person passes away, there's no change in ownership of the asset, and it will never, ever, ever get taxed for estate tax purposes. So they just pass along these assets to their kids and never pay taxes above 5 million on the estate tax. That alone, do the math, 40% off of 1.2 trillion, that's another percent right there. So I just gave you, in 10 minutes of napkin mathematics, 4% of interest we can pay for right now if we close simple, annoying loopholes in the tax code. And that's just kind of my initial, that would give us another 2 years to actually find a bigger solution for the bigger amount of debt. And I want to give a huge shout out to Rodney. Thank you for the $15. With inflation, this may get you coffee. Yeah, that's true. But thank you for that. Regardless, I really, really appreciate it. Thank you, Rodney, for that. Now, I went on a little bit of a tangent, and I'm sorry. I hope you guys found that interesting and didn't fall asleep. I don't know how many people are still here after this. I'm going to read this comment. Tom, those who are making the laws don't want to pay either, so they make laws that help their friends and themselves. Yes, this is called the lobbying system. But at some point, you have to do what's best for the country. I mean, you can't. It's just otherwise the whole system is falling apart. Some states earn tons of money by allowing offshore companies and trust funds. Yep, that is 100% true. Thank you. I appreciate it. You're probably the only one who found this interesting. Well, there's actually 1,000 people in the chat, which is insane. I don't know who stayed here. Tax palantirators. Why people hate companies they don't invest in? I don't understand this point, but okay, whatever. Okay. So by the way, there are multiple countries where there's no estate tax. But just so you know, if you leave the US to go to that location, you pay exit tax, which is the equivalent of the estate tax. So there's no way to avoid it. Now, now we're getting to the funny part of this because I prepped some funny articles to show you. So article number one to show you, which was kind of funny, and it would tie in nicely. Daniel, I can't believe you are here for this shit. It was literally verbatim what we talked about in the Zoom. I mean, this is like talk about talk about redundancy. But thank you for that. I appreciate it. So then stay for this. You'll love this. So okay. So how insane is this right now? After everything I just explained to you and the Taylor rule, the 14%, when you read this article from the Wall Street Journal, how amused are you when they're saying 3.5% will not be enough? Like, how amused are you by this? Now that we know that they know that they need 14%. I mean, right? We know that they know, and now this little group of 1,000 people knows that the jig is up, at least in this kind of living room conversation, right? So now you see what they're doing. They're sending this guy, whatever generic Fed official, I don't even fucking know his name, I don't care. So they send this, the regular generic Fed official to warm you up to the idea, hey, we need more than 3.5%. So they're starting to slowly massage you to realize, okay, so we're not even 3.5. We're right now at 0.75. So now they're saying 3.5 is not going to be enough. Now you understand, now that you've heard me speak about this and we've calculated the numbers, we did the application of the Taylor rule, you're seeing that this is ridiculous, right? And now I want to show you something more ridiculous. So this is, where is this cat? Hold on. No, where is this? Oh, I have to find him. Yes, Neil Kashkari. Yes. Okay, so this is the guy. Okay, check this out. And now tell me how ridiculous is this. And now tell me how ridiculous is this. As far as you think that the previous article was funny and it was kind of ha ha ha, you think we're idiots, how insane is this dude? Neil Kashkari is his name. Telling you that 0.75% interest in a 9% inflation environment is A-OK. We're close to neutral. Yeah, you seeing this? So now that we did this little 20-minute kind of primer on inflation tax and all that stuff, now you can read these bullshit articles on Seeking Alpha and understand how ridiculous what he's saying. The dude knows he's full of shit. I mean, he knows it's full of shit. Make no mistake about it. We're close to neutral. Now, I'm not gonna read this, but you understand now. Like, they're ridiculous. When I saw this thing, I was like, "What's he smoking, my guy?" That's insane. Okay, so people are asking about Palantir profits. I'm going to talk about in a second. I don't know if you're going to like what I have to say, but I will call it like I see it. Anyways, so before I had more articles here to show, we did this. Ford is dumping Rivian. I mean, that's not really. Okay, I found this one. Okay, so this is another article I want you to see. One more before I talk about Palantir, and then we do Palantir. So this is very interesting. So this is an article that in Hong Kong, some guy who was elected in Hong Kong to be the Hong Kong leader, blah 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 blah, and then you realize he was the only candidate running. So this guy who got elected in Hong Kong, who's the China-backed candidate, was the literally the only candidate to run, and he received all the votes, obviously. And when you look at it, it's 1,400 votes. So there's a small group of. Imagine how insecure you have to be, where it's not only one candidate, it's also letting only 1,400 people vote in Hong Kong. So only 1,400 people vote, and it's only one candidate. Like, how insane is this world getting to, bro? Um, yeah. Okay. So that aside, let's talk real quick. It's been asked. There's a question that just came up. It's been asked. Hey, Yakub, we've talked about it in the beginning of the stream. I pulled up a chart to show you historical data of how bad it can be. This is the what. If you haven't seen this part, go check it out. This is as bad as it can get. I mean, I'm gonna let you in a little secret. It can get a lot worse. Okay, so real quick, there's been hey UV, what's up? He's here in every stream. Always here. I always happy to see you. So as far as Palantir earnings go, look, you're not gonna like what I gotta say. I think we're gonna test the waters of the $8 per share tomorrow, because the thing is, uh, Palantir as a company are doing better and better. The problem is there's three things working against them as far as the share price goes, not the company itself. Phenomenal company, the stock is not behaving. Why? Well, first of all, macro is totally in the toilet right now. Inflation is going crazy. Shout out to the 1,000 people in the chat. So inflation is going crazy. People are running away from equities because they're fearful. We have Paul Tudor Jones, the billionaire, on CNBC saying, "Hey, go 100% cash." So people are running for the hills. So that's number one. And bro, if Amazon can fall 40%, Palantir can fall 60%. It's normal. So that's number one. Macro is not working in anybody's service right now, especially not a growth company. Number two, beyond the macro stuff, which are not good, Palantir has multiple SPACs on the books for which it will take a big loss, because all these SPACs that they're invested in will be devalued, and there's going to be like Ford took a big loss on Rivian. Palantir will do the same thing with the SPACs they invested in, and that's going to reflect poorly on the financials, even though it's not a cash flow item. It's just a valuation of an existing investment. But if there's one thing you should have learned by now, is that unless you have stellar financials right now with insane expectations of the future, uh, your quarterly results were going to lead to a sell-off. I mean, literally every company that reported right now, just it led to a sell-off. I mean, essentially, I would even say that there's no chance that, like, go back and see which companies reported in the past 2 weeks and which did not go down. Simple as that. So I think we test $8 tomorrow. Um, so this is a very interesting thing. We're going back to the previous discussion a little bit. I'll do it quickly. Balance sheet runoff, for those of you who are not familiar with this term, is when the Fed is reducing the amount of bonds it holds on its books. So the Fed is actively buying bonds in the free market to prop up the price of bonds and drop the yield. As they actually reduce their balance sheet, they're selling bonds, the yield goes up, interest rates goes up. It's part of the levers and mechanisms they use to control interest rate. Uh, yes, Amazon did take a big loss on Rivian. That is true. Yes, Greg is here with his favorite stock, Zim, dividend monster. So Rich is saying something very true. The stock price has changed, but nothing else on the Palantir front. In fact, I would just say, I would even go further than that, Rich, and I would say the stock price has declined, not has changed. The stock price has declined massively, but the overall performance of Palantir, as far as margins, new business, new deals, and overall performance of the company got better, which is a discrepancy. It's kind of a cognitive dissonance. Um, uh, Interesting debate here from Eric, and I'm going to address it in a second. Eric is using the debate point, which says that the Taylor rule is only applicable to persistent inflation. It does not apply to sudden shocks, and it's ambiguous if inflation and GDP growth are opposite directions. So the idea here is basically he's what Eric is saying here is that you shouldn't. It's I'm going to simplify, of course. Sorry, Eric, for this. I'm going to simplify the argument a little bit here. Is basically if it's a transitory inflation, if it's a transitory inflation, then the Taylor rule is not applicable. I would agree to this. The only problem, Eric, is unfortunately it seems that uh, the argument itself that it's a transitory inflation is kind of transitory. It's no longer here. Um, Hey Chris, what's up, buddy? Uber took a hit thanks to DD, but the business is growing like crazy. Uber, Airbnb, all this, yeah, everything is right now. It's just Palantir, I believe, has zero debt on the books, Missy. If I'm Amit is here, he probably knows, or Chris. I think they have $0 debt, no debt, which is crazy. If I show you the balance sheet of Palantir, it's insane. No debt, massive cash, massive assets over liabilities, no goodwill, 30%, almost 30% free cash flow, which means the company generated last year $1.5 billion in revenues and $424 in actual free cash flow from operations. There's not a lot of companies which can give you 40% annual growth in revenues and 40% free cash flow margins. And then you hear some idiots on Twitter saying it's not profitable because of SBC, which is also, by the way, declining. Uh, so Adele Al-Was is asking, what about the massive share dilution? I've addressed this multiple times and I spoke about it. There was massive share dilution as part of stock option plans that were granted to employees. In fact, it was insane. And I believe they did this as a prep work to retain employees for the next 4 years, to fight off companies like Amazon, Oracle, Google that will try and get their employees to take over their business. And you cannot retain employees long term with cash. You pay them more cash, Google or Microsoft will outbid you. But if you give them a piece of the business and it's a 4 year vesting plan where it gradually vests over 4 years, then you have a better chance of retaining the employee. So it's an employee retention strategy and nothing unusual. 1,034 people in the chat. I think, yeah, and Chris Patel is here. Some OG is here, one of our moderators from Discord. Okay, so I think it's a good time for me to end this with this comment from Kobe. Kobe is saying, my babushka bought into Palantir even since its decimation. She's drinking twice the amount of vodka. Okay. Great. So thank you so much for everybody who showed up and listened to me rant about the US. Eventually, so this went into massive geek mode discussion of US debt and inflation and Taylor rule and international tax planning, tax evasion, God forbid. Wow. So very geeky stream. So just to let you know, thank you for Simeon for coming up with this idea. We're gonna do this 1 hour stream every week, every weekend, that is, on a Sunday. So Sundays at 3 p.m. every week, we're gonna do 1 hour hangout, non-formal. You guys can come up with questions, just chat with me and hang out with me. Very, very, very chilled and laid back, like today. And so I felt like I spoke about it with Simeon and Greg, who are my two community leaders. Somebody saying 30% debt, Palantir. I think you get them confused with somebody else, my guy. I believe Palantir have no debt. They're definitely not 30% debt. And basically, I was speaking to Simeon and Greg, and yes, Yuri Gagarin is here, the famous cosmonaut. At least his spirit is here in spirit. He passed away, for those who are not familiar with the story, but I'm assuming that's not the real Yuri Gagarin. If it is, it's kind of spooky. So, yeah, see you next Sunday, 3 p.m. on the next stream. Every Sunday, I'm going to be here, just hanging out with you, having a good time, chatting about whatever's going on. Yeah, Chris, exactly. That's what I know. They have zero debt. I don't know where this 30% came from. And besides, what's 30% debt? 30% of what? I mean, I'll pay you 30% of what? I'm just kidding. Thank you, everybody. If you haven't yet, make sure you smash that. No, don't do it. And I can't say it. I can't. People keep asking me to say this. I don't smash nothing. Yeah, let's just be done with it. Thank you, everybody. Have a great rest of the weekend, and see you on the stream next week and on the video tomorrow. All the best.